Good morning, everybody, and welcome. I'm Chuck Williams, CEO and co-founder of Finspire, and we're an institutional retirement plan consulting firm whereby we help corporate and not-for-profit firms maximize the impact of their employer-sponsored retirement plans for their employees and their organization. In addition to assuming the role of a fiduciary investment advisor, we also consult on plan design, provide plan governance, additional resources for our clients. We have subspecializations in companies involved in mergers and acquisitions, as well as non-qualified deferred compensation plans. Finspire recently named by National Association of Plan Advisors as one of the top defined contribution consulting firms in the country. And the webinar we're hosting today is part of our Lessons Learned series, whereby we provide insight and resources to companies that on topics that we believe are topical and of value to them. And today's discussion will be on trends in retirement plan audits and how to protect your organization. So the information today is presented for educational purposes only. Should not be considered legal, accounting, investment, or tax advice. This course is eligible for 1 hour of continuing education for certified public accountants. In order to receive the CE, or continuing education, you'll need to attend for the duration of the meeting and complete the 3 poll questions that we'll be asking throughout the discussion. If you have other questions, if you have questions for us, everybody is on mute, but feel free to ask those in the Q&A bar, and we'll answer those throughout the discussion. If we don't get to any of those, we can follow up with you afterwards. So I'm going to be hosting our discussion today, along with our subject matter expert, which is RoseAnn Abraham, who is a CPA and audit partner at Baker Tilly. She joined Baker Tilly in 2006 and has been involved in public accounting since 2001. RoseAnn specializes in employee benefit plan audits and manages the Chicago region's employee benefit audit practice. I've had the pleasure of working with RoseAnn for several years, and has always appreciated her insight, enthusiasm, and genuine interest in helping companies, not-for-profits, navigate the increasingly complex world of retirement plan management. So, RoseAnn, welcome.
Thank you, Chuck. Excited to be part of this conversation, and I sure hope you all will be engaged and ask questions as we go along. And if we don't have any time at the end to answer all of your questions, please do feel free to reach out to me and Chuck if you have any specific questions. Great.
RoseAnn. So our learning objectives today, one is talk about trends, trending topics in plan governance, talk about the different types of plan audits, purpose, differences, similarities, common compliance errors, how to avoid them, and some helpful resources. So to kick this off, we'll start with a poll question, and which of the following is most concerning to you regarding plan audits? So you can answer multiple if you have multiple choices here. The first one is the DOL's recent cybersecurity guidance for plan sponsors, which RoseAnn will touch on. Impact of recent regulatory and legislative changes, a lot of that going on there. How to prepare for a DOL audit. Retirement income solutions inside of retirement plans. I'm going to touch on that, on these new products that are coming into the market. And then I'll also touch on M&A, mergers and acquisition, and that has a fair amount of impact on plan audits as well. So this is our question. We've got about 2/3 of the people have answered this. I'll give about another 10 seconds. Remember, you need to complete this for the CE credit. So we'll give a couple more seconds. I should have cued the Jeopardy music, but I don't have that handy. So we will end our poll now and share our results. Let's see, so you can, yeah.
It looks like legislative changes and the cybersecurity guidance seems to be high up there of concern. So we'll definitely talk about that today.
Yeah, yes, this is really interesting. Very good, great. Yeah, definitely spread across all those. Very good. So we will move on here. I thought it'd be helpful just as overview of the different parties involved in retirement plans. Some people get confused on who's doing what. And so first is your record keeper or third party and or third party administrator, and they're doing everything at the plan level and with the administration of the plan, setting up the participant website, call center, annual plan testing. So multiple different types of record keepers out there. So it could be a Fidelity or T. Rowe Price or Vanguard, Principal, or one of the local TPAs and third record keeper firms that you're using. And that is we have the most interaction day to day with. Fiduciary advisor, which our role is, we monitor plan investment menu, provide plan governance support, and do additional employee education resources. As your auditor, does the independent annual plan audit when required, and they're identifying areas of concern. So we're going to focus again with the audit, which is again more RoseAnn's specialization. So trending topics in plan governance, we broke these down into 3 different areas. Legislative regulatory trends, M&A activity, and investment menu evolution. So I'm going to turn it over to RoseAnn to take us through the first column there on legislative and regulatory.
Sure. So Chuck, I will start with the new cybersecurity guidance, which seems to be on top of mind of our listeners here. So the DOL did issue their cybersecurity program best practices document, which really outlines best practices to mitigate cyber risks, and it breaks down the guidance for third-party service providers and what plan fiduciaries have to follow to ensure that they're meeting their fiduciary responsibilities. So remember, you have all these third-party service providers that are offering various aspects of services for your plans. As a fiduciary, you're responsible for monitoring their activity and ensuring that, you know, all of the data and procedures that they're working with are in compliance with cybersecurity requirements. Much of the focus really is on having formal, well-documented programs that address a variety of things from, you know, identifying, assessing, and responding to cybersecurity threats. This does include risk assessment and review, at least on an annual basis, periodic awareness trainings, business continuity, and disaster recovery policies, and what do they do for that? And then incident response procedures. You know, what happens when there is an instance of cybersecurity violation? How do they respond to that? And then how do they monitor and review for cybersecurity threats? So this is, again, requirements for third parties, but for you as a plan sponsor and a fiduciary, it's really understanding how do these external parties and you yourself review and assess these cybersecurity threats. So there are organizations, consulting services that are provided by CPA firms like Baker Tilly that do a check and annual assessment and can kind of give you a gap analysis as well. And there are also other, you know, internal audit functions for various companies that take on this task as well. So again, something to remember is really looking at the guidance. It's, you know, pretty plain English. So they're provided in our resources later on, which we'll share. And it's on the Department of Labor's website. So take a look at it and see what the requirements are so you can really document what it is that they are asking you to do. The other item that the Department of Labor recently came out with is their compliance assistance 2022-1 on cryptocurrencies. So there's a lot of buzz around having cryptocurrency investments in 401k plans. And the Department of Labor basically, you know, set a reminder that courts hold plan fiduciaries to the standard of prudence and obligation as the highest known to the law. So, you know, they deem these types of investments highly speculative and volatile, and really a challenge for, you know, an everyday participant to decide and make a, you know, informed decision as to whether these assets are appropriate for future investments. So especially because they're volatile and they are hard to determine in terms of their asset value, and, you know, a wrong password or loss of that passkey can just essentially wipe out the assets you hold in the currency. So they basically warned all of the plan fiduciaries or whoever's looking to put these investments that EBSA will conduct an investigation program if you have these investments in your I guess through your brokerage accounts, if you have these as options, because they really want to understand how plan fiduciaries can offer these through the brokerage window and meet their responsibility of, loyalty and prudence and obligation in having these. So again, trend with caution. And Chuck, I don't know how many of your plans are putting these in, but I really haven't seen, any of the plans that I work with that have these.
Yeah, RoseAnn, we have not had any clients put this in. We had some discussion on it. It was interesting. Just saw an article yesterday that Fidelity just announced that they're going to allow these inside of their plans. First, I've seen that formally mention that, and it's up to do plan committees want to put them in. Yeah, most we have seen have not, just for the reasons you expressed, have not expressed an interest of adding that in.
Yeah, absolutely. I'm sure Fidelity would want it for their just non-ERISA plans for sure, to have that, availability, because this is, hot investment commodity for a lot of people. But definitely, I would say think twice before you put it in your ERISA plan. The other item that I haven't put in here are the Rise and Secure Act 2.0, which again, it's in Congress. It hasn't passed yet, but there are a lot of provisions that are coming down the pike that can make retirement, that have huge impacts to retirement plans. But again, it's not finalized yet, but we could talk about it a little later. The other major change in terms of auditing standards that came about is the issuance and the effective of SAS 136, which really is the AICPA's Auditing Standards Board issuing it in large response to, in large part in response to the Department of Labor's request to address deficiencies that they were seeing in the quality of the audit through their audit quality reviews. So every decade or so, the Department of Labor will do a review of a select sample of audits done by firms. And they break the firms up into categories based on the number of plans that they audit and the assets that are covered. What they found is an increasing deficiency in audit quality. So the last time they did it, there was about a 40% deficiency in audit quality of the samples that they looked at, with a highest range of 76% and the lowest range of 12%. And the 76% were for providers that or audit providers who audited, say, less than 10 audits a year, which makes sense, right? If you're dabbling in this is highly specialized. You shouldn't be. You're going to have deficiencies. And large firms had under 12%. So again, they're not immune to deficiencies, but it wasn't as large as what you would see in smaller audit firms. And DOL believed that part of the issue related to this limited scope exemption that was given, where by the audit opinion that is produced for a limited scope is a disclaimer opinion. And we basically say, hey, we're not providing any assurance because we're not auditing investments because of the exemption that the Department of Labor provides through ERISA to not audit those investments. Well, just because you don't audit investments doesn't mean you don't audit other aspects of the plan. So a quality audit would have entailed looking at participant activity, other contributions, distributions in the plan, and they all need to be audited. But because of this limited scope nomenclature, I think it was giving the wrong idea to users of the financials, plan fiduciaries, and perhaps to some auditors who weren't really paying attention as to what needed to be done. So this new audit standard, what it does is it carves out an entire new audit standard specifically addressing ERISA audits. And the implications are throughout the audit, from initial communication, engagement letter, and also the audit report. So this year, if you're a calendar year, plan year end, and you're doing the audit, your auditor will give you an audit opinion that's going to look very different from the past. And it'll have a detail of all of the sections that they did audit, what they didn't audit, also remind you of what your responsibilities are. So SAS 136 will say that plan fiduciaries are responsible for availing what's called the ERISA 103A3C section in order to advise the auditors to not perform certain procedures around investments. So again, ERISA hasn't changed. It's just how the auditors respond to the report that is going to be produced for ERISA audits. Again, for large large service providers like Baker Tilly, the mechanics of how we do an audit does not change. So if you've got a larger provider, a well-established, audit provider in employee benefit plans, you'll see the same kind of procedures that are done. We'll test participant data, we'll look at all of the activity, and everything is going to be pretty much the same, except for nomenclature changes in how we communicate. in all of our communications, and then asking you to take ownership and to document that in our engagement letters, that you are availing of ERISA Section 103A3C, and you're responsible for making sure that whichever institution you have can support a certification that is in line with ERISA requirements. So most large providers like Fidelity, JP Morgan Chase, all of those trustees, as long as you're a bank, trust, or an insurance company, can provide that to you. And it should not be an issue. But again, something for plan sponsors to ensure that you are getting a certification that allows the auditor to perform an ERISA Section 103A3C audit. So
Great.
That's a lot relating to the audit changes. Other than that, the last item there, Chuck, is about the DOL audit efforts going downstream. So we'll talk a little bit more about the general DOL investigative programs, but small plans are not exempt from their investigations. So it's not like they're only looking at large plans. In fact, they do look at small plans and also plans that have a lot of activity like mergers or transactions to ensure that they are in compliance with the ERISA. So we'll talk a little bit more about that. But Chuck, I'll turn it over to you to talk about M&A activity.
Great. Thanks, RoseAnn. Yeah, and one of the questions was, what are the changes in the benefit plan audit to be expected with SAS 136? I think RoseAnn covered that just a little more in depth, a little more detail on that, particularly for smaller auditor practices where this isn't what their main business is.
Exactly. So if you've seen a lot of, if you've given participant data information and you've, provided distribution documentation and such in the past, well then, nothing changes for you. But this is if you didn't see all of those coming through, if your auditor wasn't asking for all that kind of detail, then this is the time that, you probably want to revisit your audit firm and ensure that they have, the right procedures that they're performing.
Great, thanks. Yep, and we'll also show you we have some, both Baker Tilly, and we have some resources, some audit checklist things that might be helpful as well.
Absolutely.
Thank you for that. And the M&A, so the first poll question, this was not something a focus that people had interest in, so I'll just very quickly go through this. So merged plans, the last couple of years has been an enormous amount of M&A activity. And so companies that were never subject to an audit all of a sudden are, because they're doing an independent audit, because they're above that 100-person threshold. So we're seeing more of that. Plan terminations as a result of M&A, and then pooled plans, not just relative to M&A, but there are a lot more pooled plans. They might be part of a PEO, could be a multiple employer plan, or now the more recent ones are the pooled employer plan. So that has added some more complexity to the audits. And then the investment menu evolution is the third one. So these have really evolved quite a bit, and something we are focusing on with all of our clients, particularly retirement income solutions that are coming to the market. And we have been going through this with all of our clients, and I'd argue this might be one of the biggest changes we've seen since target date funds were introduced in the mid-90s. As all these products are coming into the market, as employees are staying in the retirement plans after retirement, and products and solutions are coming to the market, being added into plans. ESG, or environmental social governance, is another one, as there's been a lot of legislation on that, a lot of interest in adding ESG funds in. Self-directed brokerage is becoming a hot topic as well. And as RoseAnn talked about, these crypto and digital assets. So this has also kind of added some of the complexity, and that's coming up in audits as well to be prepared for. So
Chuck, if I may quickly add a couple notes on those merge plans, even though they may not be top of mind for our participants here. Something to think about: if your plans are merging out and you have more than 6 months worth of activity and you were a large plan, you're going to require an audit. So make sure you have all of the documentation from your service providers as soon as possible, even prior to that merger and shortly thereafter, because a lot of times, plan sponsors will cut ties with their old service providers, but 6 months or a year later, you're going to have to do the audit. Well, now you have to go back to your service provider, and you're not going to be on their, top of their list for providing documentation and such. So if you do have merger activity, please, talk to your auditor, talk to us. I'd be happy to kind of give you some information on how to be prepared with merging or terminating plans.
Yep. Yes, and also, it's good to bring up with your advisor as well. I know when we are in meetings sometimes we'll go into a review with the client. They say, oh, by the way, we bought another company 3 months ago. Well, it's a little late to do a pre-acquisition due diligence, which we typically do on that plan. So it's good that, the earlier you can let your providers know about that, the more beneficial it is, because it does take some time and some work. Great. So we'll go our second poll question. It's related to this investment menu evolution, the different products that are coming into the market. So we will launch that. So what types of investments have you added to your plan, if any of these? So I've added retirement income solution into your retirement plan. It could be a annuity option or a guaranteed minimum withdrawal benefit target date fund, or some of these retirement focused target date funds. Participant managed portfolio service. So managed account programs become very popular. Self-directed brokerage option. ESG, environmental social governance option into the plan. So let's take a look here. Looks like we've got, give another 10 seconds. I'm getting some interesting answers in here. All right, let's share the results of that. Interesting, 80% have not added any of these. But each of the other options have been added in, at least one. So that is interesting. Yeah, we're seeing more and more kind of investment menus looking different than they did even a couple of years ago. A lot of times are really in the just exploring some of these, so they might be early stage. Okay, very good. So let's see, we will close that. And talk about the different types of audits. This is often, or understandably confused about what type of audits when you talk about an audit. So RoseAnn, maybe you can walk us through a kind of brief overview of each one of these three primary types of plan audits.
Yeah, so Chuck, as I mentioned there, there's several kinds of audits that your plans can go through. If you are a large plan, so you have over 100 participants, or follow the 80-120 rule, if you have over 120 participants, you are required to have an annual audit of your plan and have that audit opinion and audit report attached with your Form 5500 filing. Now, that audit is distinctly different from the audit that a Department of Labor would take over, or an IRS audit. So we've kind of put down, what are the objectives here? So for a plan financial statement audit, really, much like any other financial statement audit, it is to provide reasonable assurance that the financial statements and supplementary information are free of material misstatement, whether it's due to error or fraud. The supplementary information, as a reminder, is not a required part of the audit of financial statements, but it's a requirement of the DOL. So the responsibility is really to ensure, and I'm sorry to take it off here, to ensure that that is in line with DOL's requirements for reporting. But it is not part of the financial statement audit. The focus really is financial misstatements. We do, as auditors, evaluate the appropriateness of accounting policies that you've used, the reasonableness of significant estimates, or if you have hard to value investments, are those values appropriate? The presentation and disclosure, and then just ensuring that the underlying transactions are represented in the financial statements. The one thing to note here, and a very important distinction, is it is not designed as an examination or review for the purposes of determining compliance with the IRC or ERISA. So that is not the primary purpose. Now, oftentimes I know plan sponsors rely on the audit to catch compliance errors, right? But just know that that is not what the audit is designed for. But as we do perform procedures, there's a good chance through the risk assessment that we could find compliance errors. And if we do, we definitely bring them to your attention. But the audit is not designed to catch every single compliance error that you have, right? That's not the purpose. The Department of Labor audit, again, usually it's called an investigation because the Employee Benefit Security Administration is the agency within the DOL that is responsible for administering, interpreting, and enforcing fiduciary reporting and the disclosure requirements for retirement plans and health plans for Title I of ERISA. So the goal of the Department of Labor is to ensure fiduciary compliance with ERISA. So what does that mean? Generally, there are three types of investigations: criminal, fiduciary, or limited review engagements. So criminal matters, if there's fraud within the plan, there's, again, fiduciary is not being appropriate with the investments and use of the money. Well, the DOL is one of the only agencies that can bring criminal charges against a fiduciary. So that's one. Fiduciary investigations are more to uncover fiduciary violations. And they're not necessarily criminal, but could lead to criminal charges, but they're really to ensure that the plan's fiduciary obligations are being met, right? The fiduciaries are acting in the best interest of the plan. And then there are limited reviews, which are really, again, aimed at fiduciary governance, but they're looking at, show me your documents, just show me what your procedures are for running your plan, so they can make an assessment of whether or not fiduciary obligations are being met. Again, as I mentioned, the Department of Labor does have authority to bring criminal or civil charges against fiduciaries and plan sponsors. And again, all plans, any and all plans are subject, large or small. If you're an ERISA plan, you can be subject to any of these audits and investigations. Now, what the Department of Labor targets includes, national projects. So they're looking for things like improper undisclosed compensation received from the plan. So how you have to provide all your Schedule A's and Schedule C's of how compensation is derived, and if the plan is paying individuals, well, they're either indirect or direct. Well, they want to make sure all of that is disclosed. Also, protecting the benefits that are due to beneficiaries and participants. So making sure that, terminated vested participant project, what that does is ensuring that all of the records and census data are effectively being updated so that participants receive their benefits. A lot of times, especially in pension plans, you hear of, lost participants. You had them participate, they were a participant, 30 years ago, they've retired, you don't know where they are, you're trying to give them the money. Well, you can find these individuals. So there's a lot of focus on the Department of Labor side to ensure that plan fiduciaries are doing what they can to ensure that all the participant information is active and that they're engaging with the participants, so that when they have, when they're retiring or getting their benefits, that it actually goes to them. Other programs that they have are, distressed plan sponsor projects, which really is when companies are either going into bankruptcy or there's news about bankruptcy. They want to make sure that, hey, all of the monies owed to the plan do get to the plan, right, before bankruptcy is filed. And then a couple other programs too would be, the contributory plans criminal project. Again, this is targeting pension and employers committing fraud, which hopefully none of us on this call have that issue. But that's really a lot of the focus on the Department of Labor. The last agency is the IRS. Here, the distinction is the IRS is not looking at fiduciary responsibility. It's more about tax exemption. So you have a tax exempt plan. How are you making sure that your plan documents are in compliance and that your plan is not, discriminatory? So that's their goal. And that's the three different distinctions, Chuck.
Great. Thank you very much, RoseAnn. One thing I brought up, I think is a really good point, is that procedures do not constitute an examination review. I'll often hear that from somebody saying, hey, how come we had an issue that didn't come up in the audit? And so we always recommend, it's often it does come up in an audit, as RoseAnn, but doesn't always. It's not really the primary role to go through every transaction. So we recommend all of our clients do is an annual administrative review. And we often facilitate that of who's doing what, and getting together your payroll, someone for your payroll provider internally, who your record keeper is, TPA, and who is doing this, and make sure roles and responsibilities are clearly outlined. And I will argue it is more important maybe now than ever, given what's happened in the last 2 years with this great resignation. We've seen more turnover companies. And so the person who's doing it, maybe didn't realize that person was doing this role. And people working remote. So, I think it's more than ever, if you haven't done that, just setting up that annual administrative review is a really important thing to do, and not just assuming that it's going to be caught in an audit.
Absolutely. And then, the other thing a lot of times people ask me is, well, how do I know if I'm going to get audited by the department? Mm-hmm. So there are different ways that they look at their investigations or their reviews. One of them is, specific targets, like they call them computer targeting, which is looking at certain specific providers, the large providers, and looking at some of their samples, right? Or they have national projects that they identify, like the distress plan sponsor program or terminate invested participants. They announce that, and that's what they're going to do. Then there's also a majority of it coming through the annual 5500 reporting. So if you fill out incorrectly your form 5500 or check wrong boxes, or have, say, things like non-exempt prohibited transactions, that is a flag for the Department of Labor to say, okay, I'm going to take a look at this plan because they do have some transactions that we're looking at. And then also from referrals from other agencies. If the IRS does an audit, they find that, there's some things missing, they can refer you to the DOL for the plan side of things. And then also from website and media and online complaints. Actually, the Department of Labor has a policy, they have a hotline. Anybody calls them and complains about an employee benefit plan that they're participating in, they have to call the plan sponsor and inquire about it. So it might just be a phone call of like, hey, we got a call from a participant saying that their investments weren't appropriately selected, or that their contributions weren't allowed into the plan and they were eligible. And on that first call, if you can provide documentation for specific instances and provide all of that real quick and resolve the issue, it might end there. If you don't have a documentation, you don't understand what's going on in your plan, that's definitely sort of a trigger point for them to say, hey, if this fiduciary doesn't know what's going on with the plan, you probably want to take a look at it. So again, really important to have a good handle on your plan, what the provisions are, and the everyday, day-to-day administration.
Great. Thanks, RoseAnn. So let's talk about some common errors in plan audits. And why don't you take us some, here's the 3 that you brought up. Maybe you can take us through these, RoseAnn. What you see.
Sure. It's not unusual, Chuck, to have errors in the plans. And some of them are, prohibited transactions, and that's okay. We do see a lot of these. But I think what's really important is taking action when you have these errors and correcting them. So a breach of duty does not necessarily mean that it's criminal or fraudulent, but really what the fiduciary has to show is that if they did breach their responsibility, that they're doing something about it. So the 3 main, again, we talked about how the Department of Labor talks about fiduciary responsibility, right? So the 3 common fiduciary breaches are failure to operate the plan in accordance with the terms of the plan document, which really these 3 are related to that particular failure, or failure to carry out responsibilities solely in the best interest of participants, and then failure to provide prudent investment options, which again, I think Chuck is your realm of expertise there. So the 3 that I've noted here are what I find is the most common errors that plan sponsors have. The first is untimely remittance of employee deferral. So ERISA requires that employee deferrals be transmitted to the plan as soon as administratively feasible, but no later than the 15th business day of the following month in which the payroll is due. So I would say, forget the last part of what I said. That's why I said it super fast. It's as soon as administratively feasible. And I think 30 years ago, one could argue that as soon as it's administratively feasible was probably at the end of the month or 15 days after. But now with all of the technology and the way we process payrolls, really what is happening is on the day you cut the checks, that's the day the assets are being transferred to your provider. That's what I most commonly see. Maybe give or take a couple of days, right? But what is really difficult about how to consider something untimely is it really is based on your process and procedures. So a lot of companies don't really write out what their process and procedures are. So when you do that, what happens is the Department of Labor will ask you for a transmission record, right? Tell me all the payrolls that you processed from the payroll paycheck date to when you transmitted it. And they'll go through and look at every transaction, and they will use the shortest time frame in which you transmitted as your benchmark, right? Because you don't have any documentation as to why something else would have been supported as your process and procedure. So in that instance, that becomes your default. And anything that was transmitted after that date is considered late, which is a prohibited transaction required to be noted on the 5500. And you have to make amends for it, which is pay lost earnings to the participant, because the idea is that if you didn't transmit it on time, you were keeping the cash for the benefit of the company, and therefore the participant lost out on the earnings that they could have had from the market. And with market being as volatile as it is, you could have had a great run if you put it in early, or vice versa. But the argument would be that you lost on the earnings. So again, what I would recommend is just ensure that you have a policy. So if the policy is, we run the payroll, we review the transactions, we have to do certain checks and balances to make sure participant accounts are right, and then we transmit it, and then there's an approval process, and that takes anywhere from 3 to 5 days. Well, that's a good process to write out. I'm not saying that's what you should do, but write out what makes sense for your organization. But once you have it written down, it's really important to communicate to all of the individuals who are part of that process to let them know this is our process. So make sure no matter what happens that it's transmitted by X date, right? And this is where, to Chuck's point, if you had a lot of turnover in payroll or HR and you weren't exactly sure who was doing this function of remitting to the trust, it's really important to understand who they are and who their backup is going to be in case they're not going to be around. So again, common compliance error and a couple suggestions on how to correct them. The next one, which, the first one, the employee remittance, usually it's not an expensive fix. The lost earnings are minimal. Usually it's, they're transmitting it a week or two later, so it's not huge. But the second one, which is the incorrect use of compensation, the definition of comp is sometimes tends to be the most expensive fix. So what this relates to is your plan document defines compensation a certain way. So they might say W-2 wages, which includes bonuses and everything, right? Anything that is taxable. But in practice, you might have in your payroll system only flagged salary wages and not taken into consideration bonus. So now your base calculation for employee deferrals, match, any profit sharing, all of that is being done based off of an incorrect compensation definition. And in our case, if you had bonuses and all that, it's a lot of money that's left on the table that hasn't been used for calculating, benefits. So if you have this kind of an error, unfortunately, it's the plan sponsor's responsibility to make the plan whole. So what ends up happening is you have to do a QNAC, put in 50% of what the employee would have deferred had their right wages been appropriately designated, and then 100% of the match or employer contribution. So that adds up really fast. And it's also, it kind of ties into the auto enrollment and escalation. So imagine if you didn't auto enroll a bunch of people. Well, now you have to put in what they would have lost in terms of the opportunity, and then any match, 100% of the match or contributions. So again, the best way to mitigate that is ensure that you're looking at your payroll and tracking all of the fields that you have set for the code to deduct for 401k or match or whatnot, to make sure that it encompasses all the components of compensation your plan defines. So, in our audit practice, we always say the plan document is the Bible, so meaning that is law. That's what you've gotten your, approval on for tax exempt status and so forth. So that is what you have to follow. So your administration has to follow the plan document. The third one, auto escalation and auto enrollment. This was very common, and it continues to be because a lot of plans are adopting auto enrollment provisions. Now, I will say the correction for auto enrollment errors did get a little bit better in the EPCRS system, where there is some leeway. Like if you make your corrections for auto enrollment errors within the year, you don't have to put in that, QNAC. But still, this is a pretty expensive error to have if you didn't appropriately auto enroll people after, your 90-day waiting period or whatnot. So if that is the case, what you have to do again is a QNAC and make the participants whole. What we usually find with these auto enrollment issues, Chuck, is that the plan sponsor thinks that the third party is responsible for auto enrolling, and the third party is saying, oh, the plan sponsor has to send me a file that tells me who's going to be auto enrolled, and there's that disconnect. So, you talked about how ensuring you understand who's responsible for what and what the roles and responsibilities are. Here's where it's very important. So don't assume that the third party is going to administer auto enrollment, and what that means is they're going to take it from you. They might be waiting for a trigger file from you that sends, all the new employees that are coming into the plan. So again, really important to understand how the process works so that you don't have any of these issues. So those are the three that I'd say, Chuck, are pretty common errors.
Great. Thanks, RoseAnn. And good point on that. That auto enrollment, that third one, could become even a bigger issue, even if you don't auto enroll. A Secure Act 2.0 that just went almost unanimously through the House, which almost nothing goes through unanimously through the House. It looks like it's going to go through, would require all plans to do automatic enrollment at 3%. So even if you're not, this might be something you will be needing to do. So yeah, that is a really important one. The other thing is reviewing that plan document regularly. So we do at Finspire with all of our clients, we do a plan design benchmarking every year with our clients. And two purposes of that. One is benchmark your plan design, see how you're comparing to companies of similar size in your industry. But secondly is to make sure everybody understands that plan document. And one of the things we look at is the definition of compensation. And that is something that comes up where our clients say, well, we're excluding bonuses. How come our document doesn't say that? And sometimes you'll see a disconnect where people think this is what it is and not realizing. So it is a really good thing to do, just to review here, make sure that plan, you understand that plan design and that it matches up, what you're doing matches up with what your document says.
Absolutely. And Chuck, one other thing I would say is that if you're adding any new payroll codes, just make sure whoever is adding them to the system understands your plan, because then they can flag it for the appropriate, inclusion or exclusion.
Great, RoseAnn. So we'll go to our final section, which is helpful resources that are available. And before we get to that, there's another question. There's a good one came up, which is, all right, well, yeah, we'll do this poll question first. This is fine. We'll do this and I'll go to the question. So question is, what are you interested in learning more about? Is it going through this? The audit readiness, is that fiduciary training, risk management? Is this something you'd like to learn more about? Trends in investments and retirement income, plan design optimization, or nothing further at that time. And if it is something you have an interest in, follow up with you just with email some information for you. And if you were, you're welcome to talk to us as well. Also, but there's just to get to more resources. So we'll give another, say, 5 seconds. We'll finish this poll. All right, let's end the poll and share the results. So entry, fiduciary training, risk management, not surprising. Trends in retirement income. So yeah, we'll follow up with just some information on those, and then again, we're happy to talk individually with anybody who would like to go into more detail on that. So we will, that was our third poll question. And another question came in, really good one. We have a TPA other than the record keeper. So this is an unbundled plan. Unbundled means you could have, let's say Fidelity is doing your record keeping, which is everything at the participant level. And then you have an outside TPA or third party administrator, which is doing compliance work and testing, and that's kind of everything at the plan level. And so the question is the TPA in scope for DOL cybersecurity requirements and our SAS 136 requirements as well? And a really good question, particularly at cybersecurity, we encourage, we do with all of our clients, is we talk to the record keeper and TPA to make sure that they are abiding by those guidance, the DOL guidance on that, to make sure. But I wouldn't just assume that they are.
Yeah, Chuck, I might add that it is a requirement because they are providing services and they are dealing with your data.
Right.
So you have to make sure that they are, they have the necessary, protocols in place to safeguard your data. And a lot of the larger providers will have what's called a SOC 1 report that on SOC 2, they also talk about IT security. SOC 2 reports and SOC 1 reports are controls around the reporting, financial reporting, but sometimes it will address a little bit of the IT security as well. So make sure that you're getting those SOC reports from your providers if they have them. Because SOC reports, if they're type 2, they do test their transactions and test, the independent auditor will test transactions to make sure that they're effective, like the controls are effective. And that's really what you want. So there are two types. One is the controls over financial reporting, and the other is controls over IT security. So you can, most large providers have these SOC reports and they evaluate them annually. So you should definitely get them and review that document. As far as 136 scope, a lot of the requirements of 136 are more from the audit and plan sponsor side, but also there is a section that does apply to the 5,500 provider, in that we cannot, as auditors, issue our audit opinion if there is not an almost penultimate version of that 5,500 available. So before we issue that opinion, we need to make sure that we have a almost complete Form 5,500 to ensure that all of the data that's reported there match to what is in our financial statements, and there is no discrepancy there. So I know that has been a standard procedure for us anyway, pre-SAS 136, because you don't want to have a disconnect between what's reported, especially on the Schedule H for us, and the financial statements, right? So we've always done that. Now it's just codified to say that you cannot issue without that Form 5,500 being available. So as a plan sponsor, what does that mean to you? Ensure that 5,500 preparation is done prior to, or in line with the audit timeline that your auditor has set for you. So if you're going to do field work and, wrap up in June, well, make sure your 5,500 is available prior to that so the auditor can review and ensure that they can give you an opinion on it.
Great. Thank you very much. Let's move on to the last few minutes here on some resources that are available.
So Chuck, up here, the cybersecurity program best practices. This is what the Department of Labor has put out for plan sponsors. It is very detailed, but very understandable in terms of the requirements that they're putting there. So please take a look. I've had my clients send this to their providers, including us, asking how we meet some of these requirements. I would definitely encourage you to do that. As part of your fiduciary governance, send this out to your providers and say, how are you meeting these requirements? And they might provide you with a SOC report, they might provide you with written answers, but that's really a good thing to have in your documentation file should the Department of Labor review your work or your plan. The other item in there, it's just a snapshot here. It's our sample initial audit request list. So if you've never been through an audit before, we do have resources that kind of talk about all the documents that we're going to need. This is obviously not a full exhaustive list of everything, but a good starting point when we start the audit of, what are we going to ask you to provide? It is a fairly lengthy document, especially for a first-time audit. We're starting to keep track of all your what we call permanent file items, your plan document amendments, any kind of resolutions that you've made. So there's going to be a lot of items to pull. So if you are getting an audit for the first time, I would definitely encourage you to start early and start gathering these documents as soon as possible. Great. Chuck, I know Finspire definitely helps with some of this for your clients, correct?
We do. And what we're showing here is a real case example with one of our clients. We redacted their information, and this is a DOL audit that they got. And they one to note is it comes from EBSA, Employee Benefit Security Administration. They sent this out to us and really gave them about a couple weeks to get all of this information to them. And it was a very detailed list of information that they needed. And they had 22 different request items. And so when we got that, we built a fiduciary file and started populating with all of that information inside that, and sent a link to the DOL auditor so they had access to it. And we spoke with the auditor afterwards, and it was interesting. I spoke with her. I remember she said, often we're looking for there's a plan sponsor organized, and what they don't want to see is they send a letter and all of a sudden they're getting FedEx packages of stuff, and they've got to figure this out because they want to just irritate them. And they think this is symptomatic that they're not really organized, and there's probably some issues here. So what we've been doing with clients is, let's assume you're just going to get an audit. And these are the questions that come into it, and build a folder so prep being ready for that. And in this case, the client, it went very quickly. It's done in 3 months, kind of went from the start. We got the 22 items, set up a fiduciary vault. It had a couple questions on it, and it was no issue at all. So just prepping for this is a really important thing. Just assume that you're going to get audited.
Yeah, and Chuck, I would add, I know that sometimes these audits are targeted because of what they found on 5500s, which are exceptions. In that case, I know that Baker Tilly offers, we have our practice and procedures group that really will represent the clients in these investigations. And what the good part of that is, it removes the plan sponsor from directly speaking or having to a certain extent. They can interview fiduciaries, but having that day-to-day interaction, or worse yet, having somebody in payroll who's just giving them a lot of information, more than what they need to go digging for issues. So having the right people be that intermediary and understanding, hey, what is the Department of Labor asking for and why, can be important in kind of mitigating, what you do provide, and just being absolutely, specific on what you do provide, no more, no less, because you definitely don't want a lot of documents in the Department of Labor's hand that's not wanted, right?
That is true. That isn't any audit, right?
Yes.
And this is like our last slide here, just some additional tools we have at Finspire for plan governance. We do a tool just evaluates 3 major aspects of a retirement plan, which is your process for investing, participant outcomes, and plan administration. This is a questionnaire we're happy to send out, and it gives a score on how well you're doing in each one, and scores each one individually, and then a total score. So that clients have found that helpful. Fee benchmarking, we do this as well. It's a good tool to make sure you're doing that. And doing that on a regular basis. There's a fairly detailed one. We also have some other tools, documentation for charters, for committees, fiduciary acknowledgement forms for members, and so on, and some best practices. And that plan benchmarking, I mentioned that before, is a really good thing to benchmark your plan design. This is a design one, compare one, just so each year you're reviewing and you understand what it is, and you can compare it to your peers.
One other thing, Chuck, I'd just quickly add is that, if you've restated your plan document, I would definitely do a line-by-line comparison. Oftentimes what we find out is, somebody forgot to check a box when they moved over to the new plan document. And now all of a sudden, like I said, plan document, the Bible. So if you've checked one thing, but, it was incorrect, or you forgot to check a box, that's going to have a huge impact on your audit. So we definitely do, from an audit perspective, a little comparison, and we try to catch that. But again, it's good fiduciary practice whenever you update documents to make sure that all of the provisions transferred over appropriately. Great,
very good. Well, kind of summary what we talked about today, kind of the different types of plan audits that are out there, the importance of having a strong process. And some of the tips was, one, just make sure you're doing administrative review each year, understanding the new regs that are coming into place and how it could impact your plan, as well as the new retirement products that are coming into the market. And then make sure just prepping, doing the work to prep for that, and understanding your roles and responsibilities of internally, your company, as well as externally, what your providers are doing for you. So you're prepared for that. So we hope you found today's discussion to be beneficial. Keep a lookout for future lessons learned programs that we have. Most of the ideas we have come from meetings we had with clients, or they reach out to us. So if you have any ideas that you'd like to learn about in the future, please, we'd love to hear from you. And you'll see that in future discussions. And then reach out to RoseAnn or myself if we can be of any assistance. If any of the tools, any of the checklists, if you like any of those, we're happy to get those to you.
Absolutely. We can definitely follow up. Like I said, we do have some cybersecurity best practices and such we can offer as well. So please don't feel shy, reach out. We'd be happy to help.
Great. Yep. So thank you, RoseAnn. Terrific job as always. And I don't see any other questions in the Q&A. So thanks everybody for attending, and we hope to talk to you soon.
Thank you, Chuck. Take care, everyone.